In the past year, commercial mortgage-backed securities made history, but not the kind anyone would want to be associated with. We're talking about delinquency rates for CMBS is hitting all-time highs as recently as January 2011. But then things dropped off, and that has some industry observers dropping the R word, as in recovery. So, will 2011 be the year things get back in track in commercial real estate? Joining us now is Ann Hambly, President and CEO of First Service Solutions. Thanks so much for your time today. We appreciate it.
Thank you.
But before we get started here, commercial mortgage-backed securities are?
It's a commercial real estate loan that a bank has created, a bank or insurance company, and then they've sold it and gotten it off their balance sheet and sold it to bondholders. So CMBS stands for Commercial Mortgage-Backed Securities.
Okay. Given that, give us a quick history of what default rates for those have done since they were created.
Okay. Well, they really came about in the early 90s, really, after the RTC days. And just as a frame of reference, there's about $3.5 trillion of commercial real estate debt in the U.S., and about $800 billion of that is CMBS. And historically, CMBS from the 90s until 2009 has hovered below 1%. So it's been about 80, 90 billion. And just recently, from January of 2009 through January 2011, rates have gone at about a 90-degree angle, and now we're at 90 billion.
Okay, and so, but we have seen some improvement in the past couple of months here. So, is this the beginning of a recovery? What's your take?
Yeah, absolutely not. It's not at all the beginning of a recovery. There are many, we've just started, in my opinion, to feel the effects of the commercial real estate problems that exist in our industry. We have many borrowers who are feeding their property, meaning they're supplementing the income that comes in, so things falsely appear not in default. We just are really starting to hit the surface. And CMBS loans have a 10-year life, and a lot of them come up for maturity in 2015, 16, and 17. So there's a huge wave coming still at us.
So there's just not even near the end of the tunnel, is from what you're saying yet.
Not even near.
So given that, what do you think default rates are going to do in 2011? Are we going to see peaks and valleys, or is it going to be a gradual type of thing?
I personally kind of see the graph continuing at about a 90-degree angle, and I personally, and I think others in our industry, predict that default rates will get up to about 150 billion or north of that. This year, by the end of the year. So a lot left.
Okay. Let's try to find a silver lining here somewhere if we can. Are there any particular kinds of properties that are doing better, commercial properties that are doing better than others, hotels, apartment buildings, other kinds of business type buildings that might lead the way here?
There are. And like you said, hotels, self-storage, apartments, anything that kind of reprices itself every day or every month will recover quicker. The ones that are longer and harder to recover are office buildings and retail. Take a retail center, for instance. You've got, the way a retail center will default is you've got consumers quit spending money, so retailers can't make their lease payment, and then they vacate their space, and then other tenants, in line with them, start vacating, and then the loan defaults. So the recovery is kind of the same process, only in reverse. It takes a long time. When
an anchor tenant starts to see problems with that can start the dominoes to fall in a particular big building. When it comes to losses, you say that there was a lot of extending and pretending that happened from mid-2008 to mid-2009. What do you mean by that?
Well, what happens when a loan goes into default, or we have this big wave of defaults that we did, the first thing that you have to do if you're a lender or a servicer, or you're on the other end of the table, is you have to try to decide whether the issue is a short blip and we're going to recover really quickly. If so, you wait it out, or whether or not it's going to be a major kind of decline in values. And so extend and pretend, or delay and pray, they even call it, comes about as a result of people just being frozen and not knowing whether or not recovery will be short-term or long-term. And so people did that for about a year, thinking maybe the recovery would happen in short order, and in reality, of course, it didn't. So.
Gotcha. So just kind of frozen by uncertainty and just not having all the facts that they want before they can make a move of some kind.
That's right.
Because of all of this, last question: will we see heightened activity in certain kinds of options for those who hold the loans, maturity extensions, interest rate reductions, differences, changes in amortization? Any of that going to be coming up soon?
It's going to have to. What happened is this extend and pretend, delay and pray was really a little bit of just modifying a payment, but not really getting to the heart of the issue, which is that there's too much debt in place on a property. So the only way to get ourselves out of this situation is to do actual restructures of the debt. forgiveness of debt, et cetera. So that's what's going to happen in the future.
Okay, well, I know it is still, there's a lot going on here, bears watching, and that is what you do for a living. So we appreciate your time today. Ann Hambly, President and CEO of First Service Solutions. Thanks for joining us today.
Thank you.
For Splash Media, I'm Renee San Miguel.